You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
Welcome back to TWIFO, This Week in Futures Options, a program where the name pretty much says it all. We break down the week that was and indeed still is on the futures options side of the fence. We're going to talk, who knows what's going to make it on the list, even though I think we have some idea what's lighting up the tape here this week. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting The Options Insider Radio Network. If I sound a wee bit different, it's because I'm not coming to you from our studio in Chicago. No, I'm coming to you from the Scenic and Sunny Risk Management Conference down here on the west coast of Florida, where everyone's down here talking all things equity volatility and the latest and the cutting edge on all things equity volatility. And who should I run into at an event like this but none other than my cohort, my partner in all things equity crime, Mr. Sean Smith, the Managing Director of Derivatives Licensing over there at FTSE Russell Land. Mr. Smith, welcome back to TWIFO, sir.
Thanks for having me, Mark. It's great to be back on the show, as always, and it's even nicer to be in sunny Fort Myers, but we're in Bonita Springs.
We are. Scenic Bonita Springs.
At CBOE's Risk Management Conference, of which FTSE Russell is a sponsor of this conference, so we're very excited to be here.
What are the odds we would see each other a few days apart at such a span of distance, sir? What are the odds you'd be down here at an equity volatility show? What would you be doing at such an event, sir?
We sponsor this event. I had a colleague from product and research on a panel yesterday afternoon. It was a fantastic panel on Russell 2000, the makeup of the index itself. We talked about volatility, and I had a gentleman who wrote a white paper from Wilshire on harvesting volatility in the Russell suite of products at CBOE. And we also had someone that actually trades Russell 2000 derivatives for a living. He is the head of derivatives trading at Neuberger Berman, gentleman named Derek Devins, fantastic. And the three of them just gave a phenomenal presentation yesterday here.
Well, let's get into it a little bit for our listeners. Obviously, we can't do the full 1 hour presentation, but maybe let's give them some of the cliff notes. Obviously, everyone, spoiler alert, has a lot of equity volatility on the brain these days, Sean. We are recording this, listeners, a few days earlier from our normal TWIFO recording date. We are hot on the heels, listeners, of the Fed making a surprise move today, cutting by 50 basis points. Before we even go any farther, Sean, did that surprise you as it surprised many others out there, jumping the gun half a point effectively when the Fed, I think it's fair to say, their chamber already maybe running a little dry, and now firing what is remaining of their bullets here this morning?
Amazing surprise to me. I think it surprised the market, even though I think there's been lots of talk of the Fed doing something, but a 50-point basis move in an emergency move without any announcement, and then the Fed had a press conference. Of which they never do following an FOMC meeting where they announce a rate increase or a rate cut. They just announce and they give you a little bit of verbiage along with that announcement. But Chairman Powell got in front of the reporters today and reported out on the necessity for this huge move in interest rates.
And ironically, all that done, I think a lot of people assuming that's done to assuage some fears on the broad economy and indeed in the market. And we saw about a 25-point rally in the S&P and similar moves in the other indices lasted maybe half an hour at the most.
And down we went.
Right back down. And this was one of the arguments going into all these Fed rate cuts for a while, Sean. I'm looking at the numbers here for the FEDWATCH. By the way, listeners, you guys can follow along yourselves, cmegroup.com/TWIFO for the TWIFO reports. Or if you want to play the FEDWATCH game, just type in CME and FEDWATCH. You can see the interesting probabilities. The probabilities were getting up there, Sean, coming into the March meeting. They weren't planning an emergency cut like they did today. No one planned an off-cycle cut. So heading into the March meeting, looks like the probabilities were ticking up in the last week or so, around 90-odd%. So they were expecting them to do something soon, just probably not today. Not today.
And so big today, right?
That was weird. We had a panelist here at the conference today point out this is somewhat unprecedented on several levels. We've had the Fed do emergency rate cuts before, but not when the economy is otherwise at full employment, otherwise doing very well. You have effectively this one outlier, which is the coronavirus. And granted, that's a huge outlier. We have no idea the extent to which it might spread and may impact global economy. But still, you have them effectively responding to one trigger, whereas most of the other key indicators, inflation, unemployment, GDP, all these things that the Fed usually triggers off of, effectively looking good. And yet they still not just pull the trigger, they pulled the trigger with pretty much all their remaining bullets today. So a fascinating time to be down at a volatility conference, Sean.
Definitely, and just a complete surprise that it happened, one, today, and two, how big of a move. The market has just taken a tremendous swing in adding volatility to all products. I'm sure I don't know if we're going to go through gainers and losers today, but
we could do that if you are so inclined today. We could do that. I'll give you the same choice I always give you, sir. Shall we go dark side or shall we go light side today?
The market's down big after popping just like you said, a 20-minute pop, a kind of a move to the upside, and then right back down again. I think the market has taken a 13-14 handle swing, or 1,000 points in the Dow, in the last few hours. I mean, it's crazy.
Yeah, we are in somewhat unprecedented waters. You're probably going to choose light side, I assume. So I could start there, or would you like to start dark side? Let's
go dark.
Oh, look at you! 2 weeks in a row.
2 weeks in a row, going dark. It's not 2 weeks. It's a week and a few days.
Yeah,
so
right.
I'm still.
We're only a few days removed from last week's show. So let's see. Let's start here. We'll do like we did before. We'll do kind of a bottom 10 because there's so many here that are highly in the red. Let's start with number 10 here. Looks like it's the Nikkei, off about a little over 6%, 6.12%. Number 9, we got silver off a similar percentage, 6.15%. WTI also coming in after silver at 6.15% as well. So tied with silver, that's been an ongoing story. WTI can't catch a bid, and spoiler alert, can't catch a bid this week either, Sean, as we continue to have concerns about quarantines and the impact on demand domestically, and not just in China, or excuse me, not just demand domestically, but internationally.
Globally, yeah.
China, everywhere else, Europe. The big FIA Boca conference, you and I were probably both going to attend next week. just got canceled this morning over concerns about coronavirus. So this is where we find ourselves, a state of affairs now, listeners here, coming into today's show. So interesting stuff. E-mini Russell, you may have heard of this, Sean, right behind WTI, off nearly 6.5% this week. Once again, it's interesting to see this little bit of a dance between the Russell 2000 and the S&P 400 mid-cap. Those two are the ones that are always leading the dance to the downside, and the S&P 400 edging out the Russell 2000 ever so slightly off 6.75% this week. Platinum off a little over 7%, 7.06%. Then RBOB coming in behind that, 7.31%. Now we got the top three of the bottom, Sean, if you will here. Number 3 here is Palladium off 8.72%. Number 2, Oats. Oats feeling the heat. They're off 9.17%. Number 1. It's an esoteric product, Sean. I'll give you a hint. Take a flying guess. What would be number 1 to the downside this week, off 10.1%? I'll give you a hint. It's not a product we normally talk about.
Milk.
A good guess. Milk actually is Class 3 milk's only off 1% this week, so that's a comparative gainer here. But
people are stocking up on their milk.
Loading up on milk.
People loading
milk
up on
and TP this week. But my wife did their Costco run while we're gone, completely empty on all things TP and all staples.
Come on,
yes, completely. So
Chicago,
downtown Chicago already has been raided. But number 1 to the downside, listeners, lumber off 10.33%. Wow. I was just discussing with people at lunch about how they thought the demand for new homes and new products and improvements would tick up. People maybe digging in a little bit in the houses, but apparently this week the lumber demand saying nay to that. Now let's go to the upside here. Let's do a similar number of names. We got the 2-year starting off the bottom of our top 10 or so here, up nearly 1%, 0.83%. Number 9, corn up 1%. As you can tell, the upside a little bit more anemic than the downside this week, Sean. Then we got soybeans right behind that, up 1.75%. Then we get into the rates land again. 5-year up 1.8%, followed behind it by the Swiss franc dollar there, up nearly 2%, 1.91%. Then we got the 10-year up about 2.4%. Then the Euro USD, 2.75%. The Yen USD up 2.75% as well, a bit of a tie there. Then we get into the top 5 pretty much. With the Ultra 10-year up 3.08%. Number 4, got the 30-year up nearly 4%, 3.82%. Number 3, the Ultra Bond up 4.15%. Number 2, soybean meal up 5.8%. Take a guess, Sean, what number 1 to the upside is by an order of magnitude. I'll give you a hint. You have some familiarity with this product category.
I'd say EURIODOLLAR.
Yes.
What a surprise!
It was up 22% last week. This week up 36%. I'm kind of scared to hit the numbers when we get to just
volume numbers. Oh my God! Yeah,
it will be doing because
a single option.
Yeah, on one strike, one caller put
million
800,000 contracts easily. All right. As we started, Sean, you guys are hot off the heels of a very interesting presentation on all things small cap volatility. I know a lot of our listeners are intrigued by what's going on from an equity volatility perspective. Come into Showtime, by the way, listeners. I'll give you a little bit of an update of where we find ourselves today. Obviously, the markets are selling off pretty hard. The VIX, aka the vol of the S&P 500, up to about 38 1/3 or so. That puts it up 5 handles on the day, and up a bit from where we were this time last week as well. Our old friend RVX listeners also up about 4 handles today at about 37.2. So that puts that spread almost unched, Sean, about 0.2 away from the RVX to the VIX.
We talked about this last week.
Yeah, this is strange.
Correlations tighten.
Yeah, they are tightening. That's one of the things I noted. When you get to your presentation, I want to touch on that a little bit as well. So yeah, Sean, it was kind of interesting seeing the notion. I know Rolf was one of your researchers there, was on the panel talking about small cap, and they made an interesting comment about kind of the spread between VIX and RVX, so obviously large cap versus small cap vol, staying remarkably consistent. And I guess over the long term, that is certainly true, but certainly we've remarked recently that is not the case. In fact, right now they're almost unched. That spread has pretty much vanished, which I can't remember the last time we've seen that. It's been a while. It's usually around a 3 or so handle range, a little more, a little less. Lately, it's been about 1.5, 1.75. So it has been slowly eroding, and this is partly due to the fact that we're seeing small caps take quite the drubbing, like we said, off substantially here this week. I'm curious, Sean, I know you were paying hot attention to that session. What were some of your takeaways from Rolf and some of the other experts you had up there talking about all things small cap volatility? Good time to be talking about such things, sir.
Yes, really just a great presentation. Rolf went into the makeup of the Russell 2000, how it's created, how it's maintained, how it's reconstituted. there's just over $8 trillion benchmarked to Russell index products. So there's a lot of money out there that uses Russell indices for benchmarking purposes. And almost 20% of that is benchmarked to the Russell 2000. I think it's 18% percentage, maybe a little more than 18%, which is really interesting. And the Russell Index is presented by Rolf was just a fantastic discussion on the fact that these are roughly 2,000 domestic stocks that have they move when the market moves, of course, but they're U.S. Domestic stocks, so they have some of that, what we talk about on the show quite a bit, insulation from various things like tariff wars, and they benefit from a lot of the tax things that that our government put in place a little over a year ago. So there's been things that move the market, but the stocks are smaller. Some of them have negative earnings. Some of them have positive earnings. Really interesting information that creates the environment of a more volatile index. And that was the discussion. Russell 2000 is a volatile index.
Well, speaking of that, it's kind of interesting. I'm looking here at some of their charts and takeaways. Some things may not be surprising to our audience, but also kind of interesting. They're talking here about how daily small cap volatility, much higher now, and not just this past couple of weeks, listeners, but just in general, this regime of volatility is higher now than we're seeing historically. They break it down, looks like from about 1979, trailing 30-day volatility now. From 1979 to about 1998, looks like it averaged around a 10% small cap vol, so pretty anemic, quite frankly. Then from the 20 years, 1999 to 2019, it averaged pretty much double that, about 20%. And right now, we are substantially north of that right now, listeners. As I mentioned, our RVX at about a 37 out there right now. So we are looking at markedly higher numbers out there. So from a vol perspective, this is kind of the story you and I have been talking about for a while, Sean. Small caps are inherently volatile. I mean, a 20% average over the last 20 years is pretty volatile in and of itself. But now you're talking about in these extreme environments, there's a lot of volatility to be found here. So I imagine for someone like you who's out there talking at a conference like this and speaking to people about derivatives and all things volatility, there's got to be, I think, a little bit of music to theirs. Maybe not this much volatility this week, but still a lot of volatility in small caps is probably a story they want to hear.
It is. It's definitely a story they want to hear. And the other thing is, with the liquidity that our exchanges help bring together on CBOE and at CME Group, there's volatility, but there's massive liquidity. And it's really exciting to see that customers can get into these markets and get out of these markets when they want to, and at a price that they can. There was somebody talking yesterday, and I don't think it was the Russell presentation, but he was talking about liquidity and how there were times where he was looking at the bid-ask in equity futures, and it was a 20 cents, 15 cents wide, but the market was 5 up, 10 up. But when he went in to do a large quantity, it got done.
Really?
Yeah.
So they were disguising their true hand a little bit out there.
I think with technology these days, these firms have a way of not showing all of their order, or they're just really, really good at trading quickly.
Who's going to show
high frequency or whatever?
Who's going to show 100 up in the futures in these markets?
In these markets, right?
That would be terrifying. You put your 5 lots out there as the hooks, and then see where they want to get hit. And then you can do size behind. That's probably a sane strategy for staying liquid, staying solvent. Exactly. And when we're moving 1,000 points at a clip in the Dow, 25, 50 points in the S&P, these are crazy times. Other interesting nuggets here, things we've talked about before. We should get Rolf on the show one of these days.
Let's do that.
He's a good keeper of this kind of data.
He really is.
I would like to ask him about his thoughts right now about that large cap to small cap volatility spread, because it's very tight, and we are kind of in aberrant scenarios, and what he thinks on that from a historical perspective. Looking here, he also has more charts here going back many decades here about small cap vol consistently higher than large cap vol. He compares the Russell 1000 to the Russell 2000, obviously the large cap versus the small cap. Russell 2000 vol, particularly in times of stress like back in the 08 financial crisis, looks like if you want that historically large volatility, it sounds like a small cap would be an interesting one. So yeah, I would be curious to pick Rolf's brain on some of these interesting nuggets. Since we're talking equity volatility, really quickly, Sean, kind of interesting note that I heard at the conference here as well. And again, this conference usually when I've come to it in the past, it's been very much about harvesting the old equity risk premium, right? I'd say 30% at least of all the presentations, if not more, are about some facet of selling 5% out of the money puts and ways you can do that with spreads and other. I used to joke this is the harvesting the risk premium conference. Not seeing a lot of that this week, which is I think probably not surprising. People have amended their presentations, but B, some other interesting nuggets. Like we've been talking a lot about the volatility surface of late in the equities and how they're pricing in a lot of interesting things this year, particularly around the election cycle, where there was a market blip in volatility futures and in the term structure of volatility, which seemed to price in maybe a little even more vol than you might think would be warranted by something like an election. And a lot of people have been asking us of late, how much of the recent volatility spike we're seeing in the equities, how much of that is due to corona fears, and how much is it maybe domestically, politically driven? Because there have been some changes on that front as well. That's a hard thing to quantify. And yet we had a presentation yesterday, I think it was by the Goldman Sachs folks, showing that spike in vol around the volatility term structure around the election actually got bigger, got exacerbated in the recent sell-offs, which if this sell-off was entirely coronavirus driven, that would not have happened. That's not what you'd expect. You expect that to actually get mitigated a little bit. So the fact that widened out showed that at least somewhere, and there is probably
there's more in the equation.
Exactly. At least there's a quantifiable amount if you dig in there. Somewhere in this volatility sea of volatility we're seeing here, there is some concern about the domestic political front, whether it's a more progressive candidate winning and something like whatever that might be. There is a little bit of something else baked in there. It's not 100% corona. Maybe it's 95% corona and 5% everything else. So everyone who's been asking us about that, there is something to that. And we'll look at that a little bit more deeply, I think, on volatility views this week. I kind of want to just put it out there because that's an interesting evolution of the volatility story we've been seeing on the equity front here, Sean. And I think, again, at a conference like this, that's something you're going to see. Let's touch really quickly before we move off of, unless you have other nuggets from the presentation or some of the other ones you wanted to share with us, Sean.
Not so much the presentations, but the makeup of the Russell 2000 index is one that it creates volatility, and that is the sectors and the weights of the various sectors within. Like in the S&P 500, you've got a high technology weight, right? You've got the Google, Apple, FANG stocks that move that S&P 500 around so much, where the Russell 2000 isn't so highly tech weighted. It's more financial services, producer durables, consumer staples, and technology is one of the smaller weighted sectors in the index. But with that, these other components of these smaller stocks, these smaller cap weighted stocks making up why they're called small caps, they're moving around a lot. And in this type of market, they're moving tremendously. So the fact that Derek Devins from Neuberger Berman spoke on being able to harvest that volatility, he does so in such a mechanical. It was just a really good presentation on being able to trade tradable products, like the RUT options on SIBO were just a perfect example in those. The put right, the PUTR, and the BXR overwriting strategies that the CBOE has in indexes as well are things that people should be watching.
That's true. There was a whole segment to that talk about the premium harvesting. So I was joking about it, but there was some of that in that session about harvesting the small cap volatility. So maybe I'm not sure if they're going to put out those reports. Sometimes they like to lock these reports, the presentations down only to this conference. But maybe,
that's right.
Maybe if they're going to put those out, that'd be something we could discuss on a future show.
Well, the Wilshire paper's out.
Is it out?
Yeah,
okay.
they actually put it on SIBO's website, so you can go to the website and you can see what Jeff Foley wrote.
We'll put a link in the show notes then, because that's the interesting one. We know historically people like their premium harvesting, right? Even in this environment, some are spooked, others are not.
Right.
So I guess if you're judicious of where you harvest your premium, Sean, that could be interesting. Speaking of harvesting premiums, look really quickly here what's lighting up this week. It's only been a couple of trading sessions, about 1.5 so far this week for the Russell 2000, Sean, here. But as you mentioned, it's off a wee bit. Actually, it's only off about 0.2% net on the week, but we're only in about a day and a half, right? So not a lot of change on the week. 1472 is where we find ourselves right now. We're seeing the big print once again, Sean, out of the money puts. 15 puts doing the lion's share of the paper here this week. And vol, as you might expect, an interesting mixed bag here, kind of across the board. All right, so yeah, a lot of interest in the puts. The vol, interestingly enough, Sean, actually down this week, about 5 points in the Russell 2000. Again, that's just because we've been reflecting the fact that we've been so elevated of late. And also interesting, again, another conversation, if you want to go deep into equity volatility and the term structure, listeners, tune into our Volatility View show later this week, a topic we've been talking about for a while there too, Sean. And we won't get too heavily here, but the volatility futures and what they've been pricing in, it's been bizarre. We're seeing the things like RVX and the VIX cash both at astronomical levels. They were into the 40s last week. And yet the futures hovering around the 26. So about 15 points below where the cash was. And everyone we've had on our network over the past week is trying to make sense of that madness. One of them has to be wrong, right? They have to, something has to move from there. The futures can't stay 15 points below the cash indefinitely. Right. There has to be, the cash has to come down.
It's got to come. They got to converge, right?
You probably can't argue the cash can't come down too much in the near term because things are moving. So we were joking that maybe people are fading some of the big volatility traders out there, like 50 Cent. They don't want to give them their full payout up there of late. But still, either way, a lot of interesting things to discuss on. We could probably do a whole show on equity volatility, Sean. But let's keep rolling. But before we go, any other nuggets you want to talk about in terms of equity volatility?
No, I think we're good. Yeah, no.
Will be the enemy of us. All right, so Mr. Sean, since you are holding court in the hot seat today, doing double duty, I will allow you to choose where we dip our toes next, sir. Do you want to go to your old friend, the 8 bazillion contract gorilla?
Let's go Eurodollars.
Let's do it. It's a beast on a quiet week. It's a beast, sir. On a week like this, I don't even want to. Should we do an over under on how many millions? What was the last time? It was 15 million contracts last show, right? It's obviously not going to be there now because it's only a day and a half into the week.
Well, the Fed did cut today, so I bet you're going to see some crazy numbers today.
We're at almost a little over a third of that, actually, about almost 6 million contracts already, just so far. Partway through the day here today. So, yeah, it looks like we're on track for a 15-plus million contract week here. But, Sean, like we mentioned, this thing is just moving and shaking quite a bit here coming into showtime. We're at about almost a 99 even, just a tick, 98.99 out here in Eurodollars land. So big moves over the course of the past week since our last show. I should mention, by the way, those numbers are top 10s listeners and bottom 10s are from our last show, not from this week. So the numbers I'm talking about now are moves for this week, whereas the numbers are talking when we do the market scan, we go back to our last show. So it's a little bit different frame of reference there. You guys can always run the reports for yourselves. CMEgroup.com/TWIFO is the place to go to get all that data. Now, Sean, I'm always leery to do it on some names. I'm doubly leery to do it on Eurodollars, which is hit the select all button because my screen is about to fill up with every trade you could possibly think of. And when I do that, it actually includes other months. So that gets us up to almost 9 million contracts already, Sean. So we're definitely going to hit that 15 million mark out here. Looks like June.
I'm a buyer of 15 million. Yeah, we're going north of that.
Probably. 9 million after a day and about a half. Yeah, so we're seeing some paper out here this week and seeing about nearly 30% of the paper here. It looks like it's coming in this June contract with the big print, Sean. 650,000 almost of the 99 3/4 calls. These are about half a point out of the money calls off of that June future here. Just guess how many of that 647,000? They did about 47,000 today and about 600,000 yesterday. So just paper for days out here, Sean, in 647,000 just in the calls. That's more, I'm sure, than WTI has done so far this week by probably several orders of magnitude. Let's see what else was lighting it up out here this week, sir. Number 2, pretty actively out here is going to be the 98 3/4 calls coming out, going away in about a little over a week, March. So actually a little more than almost 2 weeks here. And they did 487,000 of those as well this week. So kind of just a pick your month, pick your strike, throw a dart, Sean, and there's tens if not hundreds of thousands of contracts. Unless you look at the 99 1/8 puts here, these have done 500. So there you go. No love for those, Sean, but everything else has been lighting it up. Vol, as you might imagine, actually, interestingly enough, down. They were pricing in, I think, a little bit more vol to come when the Fed met later this month.
Yeah.
You got the event risk coming off now instead. People sometimes see that as counterintuitive. They see a sell-off.
Sell-on news.
Yeah, they see a sell-off. They assume vol instantly up because they have that equity mentality. But this is event risk coming out of the market here, and so we're seeing, about 20 points across the board in terms of vol getting erased here, depending on where you're looking out here. So, yeah, a bit of an aggressive vol move. Let's go back out to June because that's where the lion's share, about 30% of the paper has been so far in this week. I put in quotes, which is roughly 2 days. Looks like the puts last week, Sean, were leading the dance with they were cheap. They were about almost 5% cheap to the at-the-money, and this week they are 12% cheap, so the puts getting no love, 7% cheaper this week. The calls are about 3.5% rich this week, 10.2% rich. I think you can probably see where that's coming from.
We talked about the calls being richer last week.
And they're even richer this week, sir. So if you were loading up, like you were telling me after the show, you were loading up on all that upside Eurodollar calls, I think you're going to have your lunches on you today, sir, after this run out here. So,
you have good burgers down here in Florida? I don't know.
They probably. I'm not sure if they have the similar gourmet ones that we enjoy in the studio back in Chicago. But hey, if we're back there, we're going to have some time on our hands next week, so maybe we'll get some delicious burgers, as none of us are heading down to back to Florida for the FIA Boca Conference. These numbers here from all things Eurodollars are pretty crazy. But Mr. Sean, I'll let you pick once again if you have another product you want us to dive into a little bit, or we can see if we have some listeners who are available as well here. But any other product complexes? You jokingly mentioned milk, but we can go to milk if you are so intrigued.
I'm thinking crude. I'm thinking energy's been making quite a move lately.
Yes, it has. It's been yet another week, another bit of downside here for all our friend out here, WTI. Again, if you want to find out, listeners, head down to the drop down, go into energy, then go into crude oil and WTI. You'll see exactly where we are right now. And again, coming into showtime, again, listeners, we're on conference Wi-Fi, so sometimes things are loading a little bit slower than we desire. As I say that, Sean, everything is just grinding to a halt here. But yeah, WTI, another week we mentioned here, it was off. I think it was about 6% so far here on the week. So a rough week for the WTI bulls. I know they exist. I don't see them out in the paper flow too often, but I know they must exist somewhere. No one's out there bidding up the call wing. No one is out there really fighting for a lot of upside exposure that we see week to week out here in WTI. But I'm assuming they are out there somewhere, and if they are out there, then unfortunately it's been yet another sad week for those folks. Here we go. All right, the conference Wi-Fi finally playing ball with me, listeners. And by the way, Sean, coming into showtime now, we're seeing a decent amount of paper on the tape here as I once again hit select all, which is a terrifying process. Well over 300,000 contracts on the tape out here in WTI. So a robust week here in WTI. In fact, actually, with our narrower frame of reference here on the show, this is only going back to yesterday. So yesterday and today, WTI is actually up on the last couple of days, up about 2.5 handles at about a 47.25 right now. So from last show, it's off about 6%, but in this week, because the show is called This Week in Futures Options, for this week of 2 days so far, Sean, we're seeing a little bit of a rally out here. So maybe near term the bulls will be happy out here. Vol actually up a bit out here as well as we continue to see downside. People getting a little bit concerned. We are moving into the richer portion of the volatility skew. The puts have been bid over for a while, so we're seeing vol increasing as a result of that. Probably not a surprise that we're seeing a little bit of vol ticking up. And again, no one really knows where the downside ends for WTI as travel restrictions and demand for all things crude continue to erode. Let's look here. The lion's share of the paper so far this week, Sean, nearly half of it coming out here in the April contract that has about 14 days to go. So right under our bellwether out there. And they have done so far, let's see, that's about 44% of the paper so far this week, which is nearly 400,000 contracts total on the week. So pretty active couple of days so far. And it looks like it's the 40 puts leading the dance, Sean, out here, which, so maybe some folks thinking, before it used to be, are we going to break 50 to the downside? Then for a while there, was we going to break 60 to the upside? Now it's perhaps, are we going to break 40 to the downside? 40 puts doing nearly 20,000 contracts here this week. So could be some folks premium harvesting saying, hey, we're going to draw a line in the sand there and this far, no farther. If it drops below 40, I want to pick it up. Could be a lot of downside hedging.
Yeah, it could be buyers actually selling puts there.
Yes, it could be both, because obviously a lot of producers want to stop themselves out at a certain level. If you get below 40, that price gets a little painful for whether you're a shale oil producer here in the U.S. or other types of producers. Once you get below that 40 handle, that stops being fun for them and starts being pretty painful. 8,300 of those going up yesterday and over 11,000 going up today. A good chunk of that opening on yesterday's paper. So opening on the 40 put strike out here. Maybe not the best sign for people looking for some upside love for WTI. I don't think we're seeing that here so far this week, Sean. Let's look at the skew here really quickly. Last week, the puts were 8.33% rich to the at the money. This week, the puts actually coming in a little bit, which not surprising. We've broken through a lot of downside strikes, so some of that vol has come in a little bit. Down only 7.25% risk to at the money. The calls getting a little bit of a lift, 5.5% cheap. Actually, no, I'm sorry. They were 5.5% cheap last week. This week they're even cheaper, 6.1%. So they're getting a little bit of a sell-off actually out there. So yeah, another week, Sean, where the calls can't catch a bid out here. Fascinating stuff. I know we'd like to keep going, Sean, but you and I have more conferencing to do and more interesting, fun conversations to have. But before we go, Sean, let's go back around the horn. Let's see if folks are intrigued. Maybe they want to reach out to you and ask for those presentations directly. Maybe they have questions about premium harvesting or some of the other things going on in the world of Russell 2000. Where should they go? What should they do?
Reach out to me personally, smith@FTSERussell.com. Happy to help you. I'm sure you can get the Wilshire paper that Jeff Foley presented on the SIBO website. And if you're having trouble with that, just find me. I'm happy to help you find it.
And we'll have to get Rolf on to talk about some historical levels of volatility.
We'll definitely get Rolf on the show.
I always like a nice historical volatility perspective on the program, because sometimes we get caught up in all the turmoil of the now, right? Moving 100 points in the S&P, 1,000 points in the Dow. We get worked up about that. We forget to have a bit of a historical perspective. And that's
and Rolf's presentation went back 40 years.
Yes.
You know, the Russell 2000 has been around for 35 of those years, but he has 5 years of history added to that when they launched the Russell 2000 index. So
check that out.
So there's a 40-year look back, which is really cool.
smith@FTSERussell.com. Or just go to FTSERussell.com. They'll have that data up there as well. Give them a follow while you're at it, @FTSERussell on the old Twitters. Of course, you can check out our friends over there, CMEGroup.com as well. Generate all those reports for yourself. CMEGroup.com/TWIFO. And we'll be back to you next week, our normal recording time, hopefully with some delicious burgers in hand, Sean, as we come back to you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit FTSERussell.com, CBOE.com, and CMEGroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.